I'm going to start with the last part first. What does the Fed do and how does COVID affect it? Every single wave that we have of a new variant, we get over faster. And I think that will continue to happen. But what we saw with this last wave is that it impacted supply and not demand, which tells me that inflation is still here to stay for the first half of 2022, and it means that the Fed has to move. They made a pretty clear pivot at the end of 2021 to say, okay, the labor market is better, inflation is now our top concern, so we're going to continue to see that headwind. I titled my outlook this year as Running into the Wind. I think that we still have a positive 2022, but we are up against a lot of new obstacles, and those obstacles are mainly tightening, higher rates, and as you mentioned, the 10-year on the move, the 2-year on the move. I think, number one, it's not a bad thing if those rates go up. If the curve is steepening, it's an indication that the economy is strong. I think the economy stays strong, but stocks this year have a lot of things to trudge through in order to get to the other side in positive territory.
Because I love the way, Steve Weiss, that Liz frames this, that, you know, we've been so accustomed, for the most part, to having the wind at our backs as investors, just the way the market's done over the last many years, the fact that we've had so much liquidity in the market thanks to the Fed. Now you're running into the wind, as Liz puts it, and I like the way she frames it. Is that how you see things as well as you consider that list of issues that I put on the forefront today?
I do. And I want to emphasize one of the issues that you put forward, and that is rates. Today, the market's trading as if COVID is done completely over. And it may be because people are becoming, I wouldn't say immune to COVID, but immune to the lockdowns as demand, again, as Liz points out, remains strong, and we can all attest to that. If we see the velocity of rates repeat itself as we're seeing today, and I don't think we will, then the market's in for a world of hurt. So the Fed is going to go along with what they said they're going to do. I believe that, reading through the lines of what they said, they're going to tighten beginning in the first half of this year, maybe as soon as March or April, more likely April. So that could cause some rough sledding for the market. But if you just take a look at the volatility today, it's a microcosm and just a little bit of what we're going to experience going forward. So the question will be more, what's investors' appetite for staying in the market since it's been such easy sledding, not only in retrospect, but as we live through it with V-shaped recoveries continually. So it's going to be a market of strong hands or is it going to be weak hands? And if rates continue to move higher, are we going to see money go from equities into credit? So you've got all these headwinds. You do have this wall of worry. I'm still long. As I mentioned before, I'm going to start cutting back exposure so I have cash to buy the dips. So I think we'll still have a positive market this year, but you do have to be selective where you are.